Let me start with a question. What if I told you that most people overpay for their health insurance by at least 20%? Not because they have bad coverage, but because they don't know a few simple legal tricks? A woman in California lowered her premium by $300 a month just by changing the date she paid her bill. A family in Texas saved over $4,000 a year by switching to a plan with a higher deductible, but pairing it with an account they had never heard of. These are not loopholes. These are legal strategies written right into your policy, and yet 90% of people never use them. Today, I am going to show you exactly how to lower your health insurance premium without losing a single dollar of coverage. By the end of this video, you will know the 5 legal tricks that insurance companies hope you never discover. You will learn the one question to ask your HR department that can instantly drop your premium, the timing trick that saves you hundreds, and the account that turns a high deductible from a risk into a reward. Whether you buy insurance through your job, the marketplace, or on your own, these strategies work. I will also give you a simple script to use when you call your insurer. This is not about cutting coverage. It is about cutting waste. Let me start with the single most overlooked way to lower your premium. Adjust your deductible. The deductible is the amount you pay out of pocket before your insurance starts paying. Most people pick the lowest deductible they can afford, often $500 or $1,000. But here is the trick. Raising your deductible to $2,000, $3,000, or even $5,000 can lower your monthly premium by 20 to 40%. For a plan that costs $500 a month, a higher deductible could save you $100 to $200 every single month. That is $1,200 to $2,400 per year. The catch is that you need to have the higher deductible amount saved in an emergency fund. If you can afford to pay $3,000 out of pocket in a bad year, you should absolutely raise your deductible. You are self-insuring the small risk and letting the insurance company cover the catastrophic risk. That is how insurance is supposed to work. Now here is where it gets even better. If you have a high deductible health plan, defined by the IRS as a plan with a deductible of at least $1,650 for an individual or $3,300 for a family, you are eligible for a health savings account, or HSA. This is the single most powerful legal trick in health insurance. An HSA allows you to put money away pre-tax to pay for medical expenses. The money goes in tax-free, grows tax-free, and comes out tax-free for qualified medical expenses. That is a triple tax advantage. But here is the premium lowering trick. You can use your HSA to pay your deductible. So you raise your deductible to $3,000, saving $200 a month on your premium. Then you put that $200 a month into your HSA. By the end of the year, you have $2,400 in your HSA. If you have a medical event, you use that money to pay your deductible. If you don't, you keep the money and invest it for retirement. That is a win-win. Your premium is lower, and you are building a tax-free medical fund. The second legal trick is to use your employer's flexible spending account, or FSA, even if you have a low deductible plan. An FSA allows you to set aside pre-tax dollars for medical expenses. But here is the trick that most people miss. You can use your FSA to pay for your insurance premiums? No, not directly. But you can use it to pay for your out-of-pocket costs, which effectively lowers your total healthcare spending. The real savings come from using the FSA to pay for preventive care, prescriptions, and copays, which reduces the amount you need to claim on your insurance. The less you claim, the lower your risk profile, and over time, insurers may lower your premium. But the immediate trick is to max out your FSA contribution. In 2026, you can contribute up to $3,200. That money is taken from your paycheck pre-tax. If you are in the 22% tax bracket, you save $704 in taxes. That is free money. The third legal trick is the timing trick. Most people pay their health insurance premium monthly, but many insurers offer a discount if you pay the full year upfront. The discount is typically 5 to 10%. On a $6,000 annual premium, that is $300 to $600 in savings. But here is the hidden part. You can use a credit card with a 0% introductory APR to pay the annual premium, then pay off the credit card over 12 months. You get the upfront discount without having to come up with a lump sum. Just make sure you pay off the card before the 0% period ends. Some insurers also offer a discount for automatic payments. That is usually only 2 to 5%, but every dollar counts. The fourth legal trick is to review your plan's network every single year. Insurance companies change their networks. Doctors come and go. A doctor who was in network last year may be out of network this year. If you continue to see them, you will pay more. But here is the trick. When you find out that your doctor is leaving the network, you have a special enrollment period. You can switch to another plan that still includes your doctor without waiting for open enrollment. This is called a network adequacy grievance. You can file a complaint with your state insurance department. In many cases, the insurer will allow you to switch plans mid-year. One patient in Arizona used this trick to switch from a $500 premium plan to a $380 premium plan with the same coverage, simply because her doctor left the network of the more expensive plan. The fifth and most powerful legal trick is the dependent coverage audit. If you have children on your health insurance, check whether they are actually eligible. Under the ACA, you can keep your children on your plan until age 26. But if your child has access to affordable coverage through their own employer, you might be overpaying. The trick is to compare the cost of keeping them on your plan versus having them take their own plan. For a young adult, an employer-sponsored plan might cost them $50 a month. Your cost to keep them on your family plan might be an extra $300 a month. By taking them off your plan, you save $250 a month. That is $3,000 a year, and your child still has coverage. That is not a loophole. That is just math. Let me give you a real-world example of someone who used all 5 tricks. A family of 4 in Ohio had a Marketplace Silver plan with a $1,000 deductible. Their monthly premium was $1,200. They switched to a high-deductible health plan with a $3,000 deductible. Their new premium was $850 per month, a savings of $350 per month, or $4,200 per year. They opened an HSA and contributed $350 per month, the exact amount they saved. By the end of the year, they had $4,200 in their HSA. They paid their annual premium up front using a 0% credit card, saving an additional 5% or $420. They reviewed their network and found that their pediatrician was in the new plan. They did a dependent audit and realized that their 23-year-old son had coverage through his job. They removed him from their plan, saving an additional $150 per month, or $1,800 per year. Their total annual savings were over $6,000, and they still had full coverage for catastrophic events. Now let me address the UK and Canada. In the UK, the NHS is free, so these tricks apply to private health insurance. The same principles work. Raise your voluntary excess, the equivalent of a deductible, to lower your premium. Pay annually for a discount. Use a health cash plan, which is like an FSA, to cover routine costs. In Canada, provincial health plans have no premiums, but private supplemental plans do. Raise your deductible, pay annually, and use a health spending account if you are self-employed. Here is your action plan. Step 1. Log into your health insurance portal and find your deductible. Write it down. Step 2. Call your insurer and ask for quotes at higher deductible levels. Step 3. If you qualify for an HSA, open one. Step 4. Ask about the annual payment discount. Step 5. Review your dependents. Step 6. Implement the changes. Step 7. Put the savings into your HSA or emergency fund. Let me recap the key takeaways. Number 1. Raising your deductible is the fastest way to lower your premium. Just make sure you have the savings to cover the higher deductible. Number 2. Pair a high deductible plan with an HSA. The HSA gives you triple tax advantages and lets you pay your deductible with pre-tax dollars. Number 3. Pay your premium annually if you can. Use a 0% credit card if you cannot. Number 4. Review your network every year. If your doctor leaves, you may be able to switch plans mid-year. Number 5. Audit your dependents. Removing a child who has their own coverage can save you thousands. Number 6. These tricks are legal, ethical, and built into the system. Insurance companies just don't advertise them. Number 7. In the UK and Canada, the same principles apply to private and supplemental plans. Number 8. The savings add up. The average family can save $3,000 to $6,000 per year without losing any coverage. Here is what I want you to do right now. Open your insurance app or call your insurer. Ask for a quote with a higher deductible. Just ask. You are not committing to anything. That one question will show you exactly how much you could save. Then do the math. If the savings are worth it, make the switch today. If this video helped you learn how to lower your premium without losing coverage, hit the like button. It helps more people keep their hard-earned money. Subscribe and turn on notifications so you do not miss my next video, which is called The One Thing You Should Never Tell Your Health Insurance Company. And comment below. What is your current health insurance deductible? Would you consider raising it? Share your thoughts. I read every comment. Thanks for watching. Now go save that money. See you in the next one.